leave it at that. So you do have a bit of discretion there. And the one other item too is if there are some significant changes to your statement of shareholders' equity, then you may want to consider putting those reconciliations in. You do have your statement of financial position, which is going to show that has your equity section already. So it just depends on how many adjustments you have. So just something to consider. So going through, as Erez said, and this is sort of the meat of the presentation here. So we'll just the items here are sort of maybe your top. I'm not sure how many are up there, but your top 10 or so items that really you want to make sure that you're having a look at and considering that may cause adjustments to your transition date balance sheet. And we're also going to talk about what the differences are sort of going forward for you. But your first step is to say, okay, of these items here, are any of them going to affect my transition date balance sheet, my January 1st, 2010 balance sheet, and is it going to create any of those adjustments? So that's what these are here. So mineral properties. For the most part, you can continue to do what you currently do. That is, if you capitalize your acquisition costs and you capitalize your exploration costs, that's fine. If you capitalize your acquisition costs and expense your exploration costs, that's fine too. So you can continue to practice the same accounting policies that you're currently applying to mineral properties. I'll just point out a few things to consider though. One is that you may want to take this opportunity to change your accounting policy. Let's say that for a while now you've been considering, let's say you capitalize your acquisition costs and you expense your exploration costs, and you've been considering maybe capitalizing everything. You can decide that on transition date you're going to make that adjustment, and you can post that adjustment through on your transition date balance sheet. I'm not saying that there are any benefits either way to it, but if you have your own reasons why you may want to do that, that might be something you want to consider. It's not really an IFRS thing per se, but it's given that you're looking at your accounting policies and making a number of decisions, it may be one that you want to look at. The other item is it's a little tricky, but you can, if you want, look at writing back up certain mineral properties to fair value or to historical costs. So let's say in the past you had a property and you hadn't worked on it for a few years, and we made you write it off, or we suggested that you write it off because it really you hadn't really done much with it. But then later on, you sort of got the thing going again, and so really with the costs that you're showing on your balance sheet that you've capitalized are just the ones since you wrote it off. There are some things that allow you to write that back up to fair value or to historical cost. I think you need to have a pretty good argument that why you want to do that, and the value that you've come up with needs to be pretty strong. But it is something that it's out there, and you can perhaps do it. You need to give it some good thought and convince your auditors why it should be written up. But it's something to consider. Point 3 here. In the past, you're out looking for properties and you're spending some money. And so let's say during the year you spent $50,000 on looking for a property, and then subsequent to year end you close the deal. So what many of you have done in the past is that $50,000 you've shown it on the balance sheet as deferred expenses, and you have a note to explain it, and then to say that and then what you'll do in your next period is you'll roll it in mineral properties. But what IFRS is saying is that you can't really do that anymore. You can only start capitalizing your expenditures once you get legal right to the property. Okay, so if you've incurred Any costs that you incur up to the point that you get legal right to the property, such as an agreement got signed or you got title, something like that, those costs need to be expensed. And you have those general project expiration costs on your income statement. Okay, so that's one difference there. The other one going forward, and I kind of touched on it a little bit already, is that impairment losses can be reversed. So in the past, once you do an impairment, it's a done deal. There's no writing things back up. Under IFRS, again, you can write things, you can reverse impairment and write things back up. Again, you need, a solid reason as to why you want to do that, but it is allowed under IFRS, so that's quite a significant difference as well. Next item, property, plant, and equipment, or for many of you, just equipment, if that's all you have as for your capital assets. Fair value versus historical costs. So right now, likely on your balance sheet, you've got some capital assets that you're showing, and you've got them as historical costs, minus amortization. If you like, you can make an adjustment at your transition date and record those items at fair value. Again, you would need perhaps, depending on what they are, I think if you just have some computers and a desk, and why would you even bother doing that? But I can give you one example. I have a client, a real estate client, and they are fair valuing all of their properties because they want to show fair value on their balance sheet. What they have to do though is they have to go out, get an independent valuator to value all of their properties. You can imagine what a task that is, and I'm not sure what the cost of the company was, but it's significant, I would think. And but that's what they're going to do. They're going to make that adjustment at the transition date and write all of those properties up, I would assume, to fair value. The thing about that too is they don't actually have to have that valuation done every year. What you can do is you can have that done every 2 or 3 years or 4 years, depending on the situation. Just provided nothing changes. I mean, if you have a change during the year, and you may need to go and get another valuation if something has happened to make that considered. But if nothing has really changed, you can sort of piggyback off that old evaluation for a certain amount of time. But if there's any changes, like maybe the market dips, or who knows, any sort of significant changes, then you will need to get that revalued. Depreciation and componentization. This may be another item that you've heard of before. Again, if you just got a desk and a computer, and that's about it, or some trucks, it's really not going to be a big issue. But what this is talking about is breaking down assets to different levels. Like, just for example, let's take an airplane. Maybe under Canadian GAAP, I don't know anything about airplanes, so bear with me here, but maybe they're amortizing that airplane at 5%, let's say, the whole airplane. Componentization says you can't amortize the whole airplane. You need to break that airplane down into different components and give each one of those components a different rate and amortize it at those various rates. Because you can imagine that on an airplane, I'm sure various items fall apart quicker than others. And so that's kind of the idea behind that, if you sort of heard about componentization. Again, for your average junior company, this is not going to be an issue for you. Again, as I mentioned, in mill properties, impairments, losses can be reversed if you have impaired any of your capital assets and you feel you want to write them back up to historical cost or fair value. That is an option. We've been talking about the notes and how they're getting bigger. Here's one more area. Traditionally, most of you with your equipment, property, plant, equipment note, you would have had cost minus cumulative amortization to give you your net book value. and maybe you have it for 3 or 4 commitments, or you've got vehicles, and you've got equipment, and leasehold improvements, or whatever it is you have, and then you have it for that year, this year and last year. What you need to do now is expand that disclosure a little bit. And it would almost look like the middle property table. In other words, opening balance, additions, if you had any sales, during the year, and then ending balance. So you need to have that for each item, plus the amortization and all that. So the note is a little bit more, needs to be a bit more detailed than what we're currently doing now. Review useful life on an annual basis. So normally what you do is you just review that at the beginning, but here you just need to do it annually in case that's going to change in your calculations. Asset retirement obligations. Some of you have this on your books and some of you don't. It's now going to be referred to as provisions. So whether it be environmental provisions or provisions for retirement or whatever, but the word provisions is sort of the key word there. And under IFRS, the calculation is slightly different. I'm not going to go into too much detail on this slide, but if you do have an ARO or you're thinking about considering booking one, there are some minor differences in how you calculate it. So just want to sort of point that out. Business combinations. And the next slide is asset acquisitions. So these two slides sort of go hand in hand, and they are pretty important for this group here. You guys are doing deals all the time and acquiring companies and selling companies and so on. So this one's definitely applies to you. Definition of a business. Under Canadian GAAP, the definition of a business refers to inputs, processes, and outputs. And the argument generally has been, under Canadian GAAP, is that if you're buying a company, maybe a foreign subsidiary, and it owns a mineral property, it's got some licenses or whatever, you just sort of argue that that company doesn't have any outputs. It's not a producing mine or company or anything. And so, generally speaking, we've dealt with those and said, they do not meet the definition of a business. We're going to call them an asset acquisition. In other words, an acquisition of the asset, the mineral property, and do the accounting for it that way. Under IFRS, they've expanded the definition. You still got inputs, you still got processes, but they've added potential outputs. So really, if you're a junior company and you could have potential outputs, eventually you could be producing a company. So suddenly the definition has broadened to capture far more of these acquisitions than it had in the past. So really, if you've acquired a company that owns a mineral property, now you've met that definition. It does have potential outputs. You could eventually have, eventually produce. So you really need to look at the other two. Processes. Let's say you acquire a company and it's dormant, it's a Mexican subsidiary, and really it's a legal entity, but that's about it. And it owns has a license or two or whatever. That would not be a business that would not be a company that would be considered to have processes. Okay, processes are a company that has employees, that is actively drilling, that is doing something. Something's actually going on. So that's what it means by processes. So when you do any acquisitions in the future, so just kind of talking the future for now, you really do have to look at, the definition has definitely grown to encompass a lot more acquisitions than it had in the past, especially for junior companies. There is an exemption under IFRS. So if in the past you had acquired a company and you recorded it under the rules of of a business combination. You don't need to go back and redo that one. Okay, you can just do it going forward. Okay. You're going to see though under asset acquisitions, there is no exemption. And I'm going to get to that in a second. One item, the last item there, expense acquisition costs. So it's been a common thing whenever you have an acquisition, you know, you've got legal fees, you've got broker fees, and those sorts of things. And often you just add those costs to, you know, you've got some cash that you put out there, maybe you've got some shares you put out there to acquire the thing, and you've incurred some costs, and you've lumped that all together, and you said, okay, those are my acquisition costs. Under IFRS, if it does meet the definition of a business and it's a business combination, those costs need to be expensed, the legal costs and any costs incurred. It's only the direct acquisition costs, the cash you put out, the shares, that's going to get involved in the calculation.
Jump in for